Great to have you back. Uh, I do recall some of what you were talking about last time we were here. So we had a little bit of a delay. Has your forecast changed, or are you still a bear?
Oh no, I very much changed. I think the last time I was, talking to Blake, we'd pretty much flipped in March, and that continues to be the case. I think uh, the whole fear that I had was essentially around the possibility that the bond market remains down or sells off further, and that fear has significantly been put off the table, which is why I think the case has flipped to being much more bullish. And specifically for India, a lot is happening. A lot of things are likely to change also in the coming months.
Okay, are you no longer bearish gold? Are you bullish gold?
Oh, I'm very bullish gold. That I've always been, and I never turned bearish on gold.
Well, you know what? I hate to push back, Rohit, but last time you were on with me, you were bearish gold, you were bullish as dollar, and you were bearish indices.
Yeah,
Okay, I don't know. I
yeah,
know things change,
yeah.
but we can't revise either what was said in the past. We have to answer what caused the change, and now you're bullish gold. So, we talk every quarter. So it
Yeah.
wasn't that long ago. Let's see your charts and what you're thinking now.
Yeah, so the whole reasoning is around what the bond market is doing, and uh, the a couple of charts that I just wanted to highlight because there's a lot of discussion around inflation. So we have an entire phase, in the 40s where we've seen a lot of inflation spikes. I don't know if this is going to be the scenario, but it is something worth thinking about because you end up getting very, very different outcomes based on what we actually go through. We often just compare one time period and then it all starts looking like that. I mean, most of the comparisons are of the last 20 years or maybe only the 70s inflation. And if there's inflation, it's supposed to be bad. I mean, the only way you can slow it down is possibly, really harm the economy. But we did have several recessions and inflation spikes through the 40s and 50s. So I just, whenever I go back to the bullish case, I try to think about this. Can we really have something similar? Because it also started from a period of high debt all the way back here, World War II, and then after that, all the spending, which caused inflation, but also had mini recessions every time we had inflation come down. You had these mini recession periods. Can we really have something like this? I think that's the bigger question. Now we try to understand in that context what we are really doing. Another chart which I want to get over right at the beginning is this one. Also, a lot of the comparison we do today of where the yield curve is based on what happened in 2000, 2008, 2006. Okay, but what about this? This was a real mess, and why can't it be a little messy over here as well? I really don't know why it can't, and we just say it's like this, so it's going to be like this, and well, it can be messy. So these are two things to get out of the way so that we can think a little more clearly. So this is what I'm thinking of the bond market. You're right. I had fears on both the dollar and gold, but more on the dollar than gold and the bond market. So that is why I mentioned that. And I was thinking that the fifth wave is possibly pending on the bond market. So that was my last thought. But what has ended up happening here is just a three-wave
Yeah,
bounce in.
failing rally.
Yeah, so it ended up failing at a lower top. So therefore, if it's three waves, it's most probably a B wave. So I've just readjusted my counts to complete the fifth wave here. So that doubt which I
Yeah.
had, I think, is almost clear that this was we didn't have a pending fifth. Now that takes away a lot of risk, at least from the 1 to 2 to 3 year period where you'll see this counter trend fall. I don't know if it will be one way or is this going to be a larger 5-3-5 kind of structure, or it's just A, B, and then C. That is something we'll have to figure out along the way. But I've just put two retracement lines here, 50% and 60%. One is at around 2.9%, other is around 2.4%. So those are possible bigger retracements. 2.9 also comes close to this fourth wave low. So that's sort of maybe a minimum that we can think of going back to if this plays out the way I'm thinking.
I
Uh,
concur. I think there's a stop at about 358 before that, but I think you're looking at maybe C being 1.618 of A to
yeah,
get to those levels.
possibly bigger than that. So I only thought of the fourth wave of lower degree, which is
Yeah.
this as being an
Okay.
objective, and that sort of being close to 50%. I didn't do the
Got it.
1.618 Fibonacci.
Okay.
Uh,
Got it.
because
Get
visually
the
it looks like
picture.
it might be much bigger if I do a one. I mean, if I do C, this size C would be bigger than one for sure, maybe even
Okay.
2.618 times. Let's see.
Okay.
So with that context, I go back to the Indian bond market, and this has been one of my long-term charts. The here also the only fear of mine was that if this triangle is forming, if the global bond market falls off further, then we might still have done E and then started the next leg down, or have we done E truncated here? This has been my problem for the last 2 3 years. Sometimes when I'm bullish, I say E is over, and sometimes when I'm a little more bearish, I say E is pending. That's about where I go back and forth. But we are at the fag end of a B wave, longer term triangle. And if it is over, then what we do see from this point is a impulse down, and we've not made a new high. So I'm thinking 1, 2, and 3 down starting. So I think the sell off in US bonds, as bond yields, that is the rally in US bonds, would also be followed by a rally in Indian bonds, and possibly much bigger in Indian bonds, I think, because this wave C is already done. I mean, US bond market is down here and starting to come up from there. We are just starting to head down on this path
Okay.
on a very long-term basis. So, and a lot of triggers have happened recently. Last year, the Indian government bonds got included in the MSCI index. Just now, yesterday, there was news that JP Morgan's also including it in their index from the 28th of this month. And so as that happens, we expect that there'll be a lot of foreign investors coming into the Indian bond market, another thing which would probably drive these yields lower. And so
Okay.
lower interest rates are a big trigger as to why valuations in India, to some people, appear high and remain elevated. But on a sector and stock specific basis, it varies. Like there are some stocks that would be high, there are others which have not gone up at all and they are low. And these are not companies which are high in debt. Also, they're just going through a business cycle and they've been undervalued and they're getting attention. Like even government stocks, for example, till 2 years back were not getting any attention.
What
And then
kind
all
of
of a
stocks?
sudden,
Gambling?
sorry.
Gambling? What kind of stocks? Gambling stocks?
No, I said government, that is,
Government.
yeah, the
Okay, so
government
here's
public
my
sector.
question. Here's
Yeah.
my question. I concur with what's happening globally. Global bond
Yeah.
markets pretty much are all going to be in sync, probably just a difference in magnitude.
Yes.
So the question is, a weaker dollar and lower yields should be jet fuel for risk.
Yeah.
How long does it stay jet fuel for risk before the markets kind of recognizes why are yields coming down? And they may be coming down because there's a problem with growth, which means there could be a problem with earnings and even a possible growth scare recession. So, how long does this fuel the mania that's been going on for a while before it's a tipping point that lower rates are good when you're talking about measuring valuations and earnings, but lower yields are happening for the reason because we have slowdowns happening everywhere.
Yeah. So I've just opened the dollar chart to get a sense of that. And when we look at each of the dollar bear and bull markets, like this fall, then this rise, then this fall, some of the dollar bear markets lasting for around 7 years, 9 years, some of the bull runs also lasting for between 7 to 9 years. So that's sort of an approximation of time. So in 2008, sort of, I made the same approximation. I said, okay, if it's going to be 9 years from here, it's 2017. So this is sort of where I thought initially that the dollar bull market would end and, gold would bottom. Well, gold bottomed, but the dollar bull market didn't end. So that's part of the reason of, getting caught off guard, I would say, is this. Okay. And now when I look at it, it's possibly in the long-term channel, just the last spike for the dollar bull run, right? So you just got Z as I've marked here, usually the last wave of a counter trend move. So that puts us now at the start of the dollar bear market rather than, it should have been here. I thought initially the dollar bear market starts here. But now I'm saying, okay, it starts here. Now, if I put the same timeline, which is 7 to 9 years from here, even if I take the minimum seven from 2022, we end up at around 2029. Okay, so that sort of gives me, sorry, sort of gives me a time horizon to play with, that this could be pretty long in terms of number of years. It's not something that should end in 6 months or 12 months. It should be something that's going to go on for a couple of years, which then fuels a lot of the emerging market. Let's say every time you've had a dollar bear
Yeah.
market, there are two things that have happened. One is the commodity cycle,
Yes.
which is a beautiful intermarket divergence, which means that the new high in the dollar in 2022 did not result in a new low in commodity prices. And that is, I think, a very strong long-term signal for the commodity complex, because that means that the 66% retracement we saw in the Bloomberg Commodity Index is only a wave
All
two.
right.
I can actually just show that chart.
All right. Well, looking at this chart, are you looking for wave B that high if you go back to where you were before that prior chart?
Yeah, so no, I'm not looking for that high. I mean, I just put it there. Wave B could
Okay.
also end right in here, because this entire structure is sort
Doesn't
of like
look,
it's
yeah,
sort of like
doesn't
a
look,
triangle, a diamond kind of pattern. Yeah.
all right. Doesn't look like we're on the precipice of a breakdown under 104.
Yes,
And
it does. It does. So I'm
okay.
just watching those weekly averages.
All right.
The weekly averages on the bond market have broken, but on the dollar have not. So both have not
Mm-hmm.
confirmed. So that remains the last point. You're right. Once we break that, then I think sort of I would conclude that B is done over here. So
Okay.
that is the last support that we are really watching.
Yeah.
And what I was trying to get at is the immediate impact of that. First, I see is the Bloomberg Commodity Index here, which had this long
Yeah.
bear market WXYZ. I was
Yeah.
referring to this intermarket divergence. So the new high
Yeah.
is approximately 2 years apart between the DXY and the commodity index bottom. And that's this is pretty much normal. I mean, it's the same thing we saw in 2008 to 2011. You didn't see a new low in the dollar index itself, but you did see new highs over here in gold, copper, and
Yeah.
some of the commodities, silver. So the same thing here. There is a lead lag, but eventually we are heading to what is going to be a dollar bear market and what is going to be a commodity bull market. So this is sort
Okay.
of the bigger picture. The other thing which
Okay.
happens with the dollar bear market is emerging markets, right? We saw that between 2002 and 2008, emerging markets had a beautiful run. And if I simply move to, say, the EEM, right, the MSCI Emerging Market Index, okay.
So let
Uh,
me ask you this: with the falling dollar,
yeah,
um, you're not necessarily saying that the S&P. I want to get to the S&Ps, but
absolutely.
because but it is going to be more bullish for non-dollar denominated equities and possibly bonds because of the weakness in the dollar. That other markets, that money will flow towards the emerging markets more than the US, which, that old thing about exceptionalism, we're going to get a pretty good chink in that argument with a bear market in the dollar. So US may not end up being the cleanest, sturdy shirt going forward with a bear market in the dollar.
So it's more of a relative performance question, which
Yeah,
means that it doesn't mean that the US market goes down, but
right.
it does mean that when emerging markets start breaking out and have the MSCI EM index on board, which
US
is just breaking out,
underperforms. Well, that's
US
a big
underperforms.
deal because
Yeah,
it's been overperforming for years now,
yeah, yeah.
right?
Now, will all the emerging markets do it? So the EM index is just starting to break out, but if I look at India in specific, where I am, we
Yeah.
have already been outperforming the US. So I'll just show you that chart. This is a ratio
Oh,
chart.
Yeah.
This is a ratio chart of the Dow Jones to the Sensex. Okay, both are 30 stock indices.
Well, you picked the weakest index to measure it
That's a good
against.
one.
Okay, well, it's true, isn't it? I mean, why don't you put it up against the
Yeah,
Qs, bro? And I
yeah.
think you'd have a different picture.
That's a fair question.
All
Fair
right,
one.
go ahead. You have a selective selective research on this one in favor of India. So,
Yeah.
okay, go ahead.
Yeah. So definitely on this one, very similar to what we saw.
You're
So
a tricky
then,
guy, but you can't get much past Dale Pinkert when you're trying to do these things. So go ahead, buddy. I'm not your
yeah.
normal host. I
No,
trade.
definitely.
So anyway, go ahead.
Yeah, I'm looking at the same period essentially when the dollar was in its last bear market, which is 2002 to 2006, 8.
Yeah,
And during that phase, you had the Sensex outperforming the Dow, not here, right?
yeah,
So the same thing happened here. We had the Dow outperforming the Sensex till 2020. But
yeah,
now you have the Sensex beginning to outperform the Dow. So that's
yeah.
just idea.
Okay, okay. What do you have upside targets in SPX around 6,000 or 7,000?
Yes, I'm beginning to see that. So this is a wave count of the SPX here. I think, discuss this as an alternate last time, but it's now slowly becoming the primary because initially I was wondering whether this is going to be ABC, okay, and end at this. Now we are switching to marking it as an impulse, which means 1, 2, 1, 2, 3, 4. We have another 3, 4, and a 5 to go, which I think will get us past the 6,000 mark for sure. Will it get as far as 7? We'll see as it develops, but it opens up all those possibilities
Okay.
now that we're looking at an extended impulse in developing here. And so, what I also want, if we want to still feel further comfortable with this, and what the bond market will do is we should get those breakouts in the US banking and the US Russell, which is the small cap indices, which is where the broad participation should really kick in. So I've been watching that every day. When is it going to break out? Banking has given some signs. The Russell has still not gotten past its recent highs of the last 6 months. But once that does, then I think that would also be a clear sign that the environment has sort of changed.
And will people rotate out of tech to buy Russell and so forth? Will tech begin to underperform? This is the value play that people have been waiting for a long time, right?
Yeah, the relative performance question maybe more short term. I mean, it's possible when the rebounds happen, like when you do those quick catch ups, you may get short term outperformance of those segments. But will it really end the tech rally? Maybe not.
Okay. Can you see anything that could trip up the bullish case for equities? Can we have a bear market rally like TLT back to about 120? That's only 38% back of the whole fall. If you look at TLT, could we have a bond market rally and stocks stumble?
So that is sort of why I actually started with this chart, that all the prediction around recession is based on 2000, okay, what happened here, or what happened here in 2008. In these events, you had this small inversion, and then moment it started to steepen, the market fell, bond market rallied. And I think all the predictions have been around expecting the same over here. But each of these were non-inflationary environments, right? You had a period where after 1984, inflation was consistently down, the bond market was in a bull run, and that is not the situation today. And so when we are comparing these inversions with today, we are doing away with the other macro factors and saying they don't matter. I say they possibly do, because you need to compare an inflationary period with this, and the last inflationary period, it had lots of inversions, de-inversions through the 70s before you really got out of. So are we really looking at this thing correctly? I really wonder. And then if I look at the other thing, when inflation stopped rising and bond yields started to fall after 1982, the stock market started to go up. And
Right.
so, why shouldn't that be the correlation, that when the bond market starts to rally, the stock market goes up? Why should it be the other way around? So, Will falling yields be a sign of a recession? Possibly not. They're just a sign that inflation is, behind us for the time being. And then that takes us back to this chart, right? It takes us back to the chart saying, sure, it's behind us. We can have future inflation spikes. But till that point, the market might just, have its own course.
Okay. You had pretty wild markets after your elections there a few weeks ago.
For a
Um,
day, that was for a day, the
yeah,
market was volatile.
right.
They just got scared about what would happen if we ended up with a weak coalition government. Well, the government that has formed has been the same parties that have been together for the last, 10 years. So there was actually no reason for that fear. But I think people got excessively, there were a lot of bets on both sides of, the elections in India, a lot of speculation. If we actually look at the long short ratio, we had the highest long and short positions held by two major groups. One is the foreign institutional investors, and one is the local and HNIs, and those groups. And I think that's the cause behind the volatility. But that's it. It just lasted for a day.
Okay. Yeah, that was a pretty wild day. Um, you have upside targets for gold and silver?
Yes. So I'll just open up my gold and silver charts.
And also, I wanted to ask you if your view has changed in oil because I'm looking at oil possibly being able to rally back above $100. So,
Yes, so I'm thinking of the entire commodity cycle, right? So if that
yeah,
means that all commodity prices start to rise,
okay,
the good news would be if they rise slowly, because then it doesn't have the kind of inflationary setback and fears, which is
yeah,
usually when there's geopolitical risk, right? Right now, what we are thinking is not geopolitical risk. We are saying a weak dollar, low yields driving up maybe demand and therefore commodity price cycles. So that should
okay,
not be an issue. So starting with gold, sorry, this is silver. In fact, today I think if silver closes positive, my RMI indicators will be triggering buy signals over here.
okay.
And in the near term, at least, what we'll be looking for, I look at both the near term and the big picture.
34,
Yeah, something more than that, I think, because this is my first. Sorry, this is my
okay,
first wave, and I'm
okay,
looking at. So this is at least $36, but I
okay,
think it's not even that, because if I just subdivide, if I just look at this, yeah, somewhere around, both are pointing to the same place. Around $35, you're right, is
okay,
the next target for silver. But in the
okay,
big picture, and which is what really fascinates me, because silver has really underperformed gold for a long period of time. And I think in the big picture, we sort of completed this phase, where we were below 50, the highs over here for such
yeah,
a long period of time, $30
yeah,
odd. And we are breaking out of that. So I think we started the third wave, which gold has already done. We are starting this wave one, two, and we're starting three. This should actually get us back to the all-time highs or close to the all-time highs again, with something which has
okay,
been long pending.
okay. All right, great presentation. Thanks for, trying to fool me with using the Dow in comparison study. And and thanks for your transparency and you know, we're all wrong at times, Rohit.
Yeah,
It's about changing your mind when you have the evidence to change your mind.
very
And
true.
yeah, so really the big takeaway is global bond market rallies along with the weaker dollar.
Yes,
That's your highest conviction scenario here. And higher markets, risk on continues because of those two tailwinds.
right.
Okay, did I summarize it okay?
Absolutely, absolutely. We just didn't put any numbers to Nifty, but I think the Indian market just does pretty well, or much better than most of the emerging markets.
Okay. And Rohit likes his domestic market. So I would pay attention to Rohit, right or wrong. He's more right than he is wrong over the years since I've been talking to him, and he takes WD Gann's saying if you don't learn how to change your mind, you won't have any change left. He's flexible to change his narrative when the evidence tells him to. So best way for people to follow you, work with you. You could probably show your website now, Rohit, so people know
Yeah.
how to find you.
Yeah, so there are a couple of things we do. There's of course web.strike.money. This is the new thing we've launched on essentially Indian markets, where you can get all the market data analytics related to the Indian markets on this platform, which is web.strike.money. And I do write. I still publish at indiacharts.com. And we essentially have an India Charts app, so that is the best way to really download and start reading the commentary that I put out on a daily, weekly, and monthly basis.
Okay, you also teach. You have a
Oh
mentorship
yeah,
program.
we do a mentoring program once a year. We take a batch once a year and teach them from basics to everything till position sizing, Elliott wave analysis, and so on.
Okay. Well, may pips rain down on you.
Thank you so much.
Till the next time we talk later in the summer, early fall, Rohit. Thank you for coming here and sharing your work and putting up with my barrage of questions for 30 minutes.
Complete pleasure. Thank you, Dale.
All right, Rohit Srivastava. Follow him on X at India Charts. Great technician, in my view. And I love his work. So everyone, have a great day the rest of the day. Good hunting. And remember, don't just count your Elliott wave counts, count your blessings. And we'll wrap up the week TGIF tomorrow. Adios, everybody. Thanks again, Rohit.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.